Right, so of course want to look at question 8 from this tutorial later there. All right, so that's like in total the question was out of 20. All right, I believe the other parts were not here. All right, so it says prepare the journal entries, all right, for the financial years ending 30 September 2022 and 30 September 2023 in respect of transaction 1 in the records of Ultra Motors, right, Limited. Please note, ignore depreciation journals in respect of machinery. Journal narrations are not required. Ignore any normal income tax implication. Ignore the time value of money. Let's quickly see what's happening in terms of transaction 1. So the financial manager of Ultra Motors. Ultra Motors is a company that manufactures and sells vehicles and vehicle component parts. Most of Ultra Motors products are exported to Australia and America, although some products are sold in the local market. Ultra Motors manufactures plants are located in Port Elizabeth, and most of the exports are made via the Port Elizabeth harbor. Ultra Motors financial year end is 30 September, and you are currently compiling the financial statements for the year end of 30 September 22. This financial statement might be submitted for approval at the directors' meeting on 15 November 22. Except for transaction 1, which was correctly accounted for, transaction 2 to 4 must still be accounted for in the financial statements of Ultra Motors for the year ended 30 September 22. Right, this is a very important statement. All right. Transaction 1, import of machinery. On 1st of September 22, a non-cancelable order was placed to import a machine from Australia. The purchase price of 99,000 Australian dollar was paid on 1st of December 2022. The machine was shipped free on board on 1st of November 22. Ultra Motors obtained control of the machine on 1st of November 22. On 1st of September 22, Ultra Motors entered into a forward exchange contract for an amount of 99,000 Australian dollar in anticipation of the future import. The FEC expired on 1st of November 22 and was not renewed. Ultra Limited does not apply hedge accounting in terms of IFRS 9. The exchanges applicable were as follows. So literally, these are the exchanges that we have. So the question that we have in terms of that part is asking for, it says prepare the journal entries for 30 September 22 and 30 September 23. So that's the journals that they want us to process. All right, so let's look at it. All right. All right, so looking at journal entries, so we'll start off with 30 September 2022. So that's the first part of the journals. So what is happening on this debt? All right. So in terms of this, all right, they entered into an FEC, all right, which is a forward exchange contract. So let's understand what is an FEC, all right? Now, guys, an FEC, right, is a method that we use to hedge against, of course, the future unpredictable circumstances. So we call it forward exchange contract. All right, so what happens now on the FEC now, especially like in this case, all right, the hedging against the losses in the rand against the Australian dollar. So that's why they entered into forward exchange contracts. So what happens now is the company that we're dealing with approaches the bank. All right, so they approach the bank and say, hey, look, Mr. Bank, I'll need Australian dollars on a specific debt. All right. And then the bank will say, okay, no, that's fine. We'll sell to you Australian dollars, but let's agree the exchange rate in that regard. So they will agree the exchange rate in regards to this transaction, but they'll say, no, this is the rate that they're going to be selling the dollars to each other at a future debt. So the rate, say, for example, today is 29 March 2026. So we go to the bank and say, hey, Mr. Bank, we're going to need Australian dollars, possibly say on 31 December 2026. Then we agree on an exchange rate today with the bank. All right, so in terms of the agreed exchange rate now, which means now in terms of this, we can sign the contract, all right? We give the bank, of course, the signed copy, and then they keep that signed copy there. So that is how it works in regards to this part. All right. So now let's proceed now, all right, in terms of this. Let's see now what's happening in terms of this part of the equation. So On 1st of September 22, a non-cancelable order was placed. All right. Excuse me. So in terms of this, they entered into a non-cancelable order. All right. And then let's deal with the FEC. So on 1st of September, Auto entered into a forward exchange contract, FEC, for an amount of $99,000 in anticipation of the future import. So what is going on in regards to this? We do not process the transaction on 1st of September 22, but rather we're going to process the transaction. Normally we process the transaction at maturity of FEC as well as at year end, right? But however, in this question, they want us to process a transaction in regards to 30 September 2022. So we need to account for that in this regard. So let's quickly see what is happening now on 30 September 2022. Right. So we then assess when they entered into the transaction. Look, they entered into the transaction under the FEC. What was the exchange rate on that? Right. So we need to understand one, we need to pay attention on the maturity date of FEC. On maturity of FEC. All right, it's very important that you pay attention. When does the FEC mature? So look at this. All right, the FEC expired on 1st of September 22. So it means now the FEC was from September 22 up until 31 October 22. So do you see in regards to this is a 2 months FEC? All right, so in regards to this, the FEC, all right, it ran from 1st of September. All right, so it ran from 1st of September up until 31 October 2022. So literally this is the period the FEC ran. So it's 2 months FEC, right? So you find that in the exam sometimes, right, you know how it is like with the examiners, right? So in the exam, sometimes the examiners can give you different rates. Like you see here, they give you the 2 months FEC, here they give you 1 month FEC. So it's important to note which rate you're going to be applying. So in terms of this part of the question, as you guys can see, the FEC, right, is a 2 months FEC, so which means on 1st of September 22, when they entered into the transaction, the FEC was trading at 8.18. That's the day they entered into the FEC. All right. And then now let's look at 30 September 2022. All right. So on 30 September 2022, you're going to find now how many months are left on the FEC to mature. Right, so in regards to this, since the FEC is maturing on 31 October, which is more or less like 1st of November, so the FEC is left with 1 month. So which means now in regards to this, you use, in terms of this, you use the exchange rate now for 1 month. So on 30 September, we compare the rate for 2 months FEC with 1 month FEC. So the 2 month FEC is the one that we had on 1st of September. Remember the FEC on 1st of September was left with 2 months. Now on 3rd September, the FEC is now left with 1 month. So which means now in terms of this, look at it. If, all right, in terms of the deal, all right, we agreed in regards to this, they agreed now that they're going to be buying the dollars at 8.18. Look at it. This is the deal. But now the FEC is now sitting at 8.32. So do you see in regards to this, the value now has gone up, right? In terms of this part. So the value has gone up. So it's beneficial to them, right? If they delayed in entering into the FEC, they could be buying the dollars at 8.32. But they were clever in entering into the deal. They're buying the dollars at 8.18, which means now it's a benefit to them. They made a gain. All right. So in terms of this, which means now, all right, in regards to this, they are sitting on an FEC gain. So you debit FEC, FEC asset, all right, which is statement of financial position, of course. Then you can record it, FEC gain or fair value gain, whatever you want to call it. Fair value gain, you record it in P&L. All right. So which means now the fair value gain, you calculate it by saying, all right, in terms of this, 8.32 minus 8.18. I don't know if it's clear the concept about FHC there, guys. Please let me know if you guys are confused so that we can clarify it. Right, so basically that's how we come up with the game. Right, I'll try to write that down so that maybe you can follow it as well during your own time. Right, so the FEC gain now is sitting at this. I'm going to write that down. Right, so which means now the company, right, agreed with the bank, right, to buy Australian dollars, right, at a rate of 8.18. So this is the rate they agreed at, all right? But now, on 30 September, all right, the exchange rate on FHC is now at $8.32. So it's now $8.32, which means now the company now made a wise decision. All right? They could have bought the dollars. They could be paying in regards to this 8.32. So literally in regards to this, right, based on the deal. So on deal, agreed buying rate. So the agreed buying rate is 8.18 times 99. So this is what the company is going to pay the bank. All right? This is what the company is going to pay the bank. And then on 30 September, all right, the company could be paying if they delayed. All right. So the company could be paying, but however they were clever, could be paying 8.32 times 99,000. But because they were clever in regards to their deal, so this is what the company could be paying to buy the dollars. All right. So look at it in terms of this. The company actually made a gain. So they could have paid, they actually agreed with the bank to pay 809,000. But now, because the FEC now has gained value, so it means if they delayed, they could be paying at 8.23. So the company will be happy, to say, no, we're clever in entering into the FEC because the exchange rate now has gone up. All right, let's see what we have on the questions there. All right. Right, I'm still confused if maybe you could re-explain which part. It's a bit confusing for me, the man's part. Right, guys, explain further what you mean by the man's and which part is going on there. Just quickly have understanding in terms of the FEC. Quick. I don't know if you sent this before I wrote this or what's going on.
Again,
Yes, sir.
okay, I'm saying that I always get confused, especially in absorbing the information regarding the FEC when I'm reading the scenario. I, I don't know where to start, what's happening.
Hmm. Okay. All right. But now,
Yes.
in terms of this, you need to understand. Remember, when you talk about FEC, the first thing that we need to do is, do we understand what's going on with FEC? All right? Think about it. You go to the bank, right? Hey, look, bank, I'm going to need foreign currency on 31 December, right? You're going to need foreign currency on 31 December 2025, 26, right? Now, what's going on? So the bank and you will enter into an agreement. The bank will tell you that we have a forward exchange rate that we use. So now, in terms of this, the bank will say our FEC, which is a 2 months FEC, right? By 2 months, it means this is when the FEC expired. So when they entered into the deal on 1st of September, they said, no, an FEC that expires in 2 months currently is trading at 8.18. So in other words, they are saying you buy dollars at 8.18. Are you with me so far?
Yes.
All right. So you're going to buy the dollars at 8.18. On which date? On 1st of September 2022. You see here, 1st of September 2022, you're going to be buying dollars at this rate. All right? This is how you're going to be buying dollars. So on 1st of September 2022, you're going to be buying dollars at 8.18. Now, Mr. Lerato, I heard you said the 2 months and the 1 month confuse you. Are you fine so far? All right, good. Okay, cool. No. 1st of November, just took 1st of November is like 31 October. Remember, November and October, there's a difference of 1 day. All right? So that's what we have in terms of this. All right, so which means now, since we have it sitting there, so we have it there, all right? And then we then move on to the other part, all right? Now, on 30 September, right, which is after 1 month, 30 September, the FEC is left with how many months to maturity? Our FEC is now left with, remember, we're now on 30 September. From 30 September to 1 October, there's 1 month. How many months left? 1 month, right? We just have 1 month left. So which means now we use the exchange rate for a 1 month FEC. So the exchange rate that you use for FEC is for the remaining period in terms of FEC. That is how it works, right? In terms of the FEC. All right, now let's proceed to the next part, right? So that we can see now what is going on next in terms of our FEC. So we have it there. Now, the next thing, right, that we need to look at, right, is to compare now. So we now have to compare in terms of this. Remember, when you entered into the deal, you agreed with the bank that you're going to buy the Australian dollars at 8.18, right? But if you had delayed, you could have been buying at 8.32. Do you see you made a profit in this regard? Are we on the same page so far?
Yes.
Good. Miss Lerato, are we on the same page?
Yes.
Good. Now let's proceed now. So we have accounted for the first. I don't know if there's anyone who's lost as well before I proceed. Okay, now let's proceed, right, in terms of our journal. So we've done journal 1, so which is FEC. Just pay attention, the FEC again, we record it in profit and loss, in terms of that. So record it in P&L. Then we move on to, is there any journal 2? On 30 September, looks like there's nothing, right? Now let's pay attention. When is the asset shipped? So in terms of this, the asset was shipped free on board on 1st of November. So in terms of this, something of note, all right, free on board. What does the word free on board mean? It means now the buyer is now responsible for shipping cost and insurance on the asset acquired. So it means now, so when you see a transaction, an asset being shipped free on board, it means the risk and rewards transferred to the buyer on the shipment debt. So which means now we recognize the asset acquired on the debt. It is shipped free on board. All right. Another option that they have in terms of shipment, right, is whereby they come in and say, cost, insurance, and freight. Right? So sometimes they give you this. So it's a freight, right? They just write it like this. It means now in this case, the seller is liable for transport of the asset. All right. So which means now we recognize this asset. The debt it reaches South African harbor. All right, so in terms of this, they tell you that it reaches South African port of entry on this date or South African harbor on this date and all that. So that's how you go about it in terms of the shipment. Right, so which means now the journal that we have to process on 30 September is just 1, all right, since the asset hasn't been shipped. Now let's move on now to 30 September 2023. All right, so 30 September 2023, that's the following year's year end. So 30 September 2023. So we have to do journal 2. All right, let's first deal with the FAC. Then when the FAC is done, we can account for the things. All right, so let's pay attention in terms of this, what's going on now with regards to this part. All right, so in terms of the FAC, let's quickly go. All right, so we're told now that the FAC expired on 1st of November 2022. So which means now, 1st of November 2022, that's the expire of FAC. Right, so that's the date that we have in terms of the expiry of the FAC. So when to assess, do we have a gain or do we have a loss in terms of our FAC? Right, so which means now, in terms of this, right, let's quickly assess now on 1st of September, since it has expired. So when the FAC expire or mature, we now use the spot rate. All right, so in terms of this, when an FAC expire, all right, or mature, all right, we now use spot rate. So we compare now. We're no longer going to say, let's compare the 2 months FAC. Remember, the FAC no longer has 2 months. We're not going to say, let's use 1 month because the FAC no longer has the 1 month. It has reached its peak. So we compare now with the spot rate. So what is the spot rate now on 1st of October, 2022? Right, so in terms of this, right, let's quickly see now, right, in regards to this to see now what is going on in terms of that part. So if you look at it, all right, in terms of this, so you're going to see now that in terms of this, our FAC was previously valued at 8.32, all right, and then now it's valued at 8.30. So it means now, do you see, we are also sitting on, we are now sitting in a loss in terms of the FAC, all right, so we remember the valuation that we did, we valued our FAC to 8.32. So we're saying, no, in regards to this, we could now, in terms of this, right, we have our FAC now, we agreed at a rate of 8.32, but now the FAC is now trading at 8.30. So that means now we're sitting on the FAC loss. Right, so we have fair value loss. Regards to this, we record it in the P&L, right? Then we credit FAC asset. Right, so in terms of this, or somebody could come in and say, remember with regards to the FAC, the asset. So you can see the value of your asset was higher here, now the value of your asset has gone down. So which means you have a loss there. So we have 18.32 minus 18.30 times 99,000. So that's the loss now that we made in regards to this part of our FAC. Are we clear, guys?
Hi.
Yes, Sam.
Yeah, if you could elaborate further, I'm confused a bit. I do understand that when we look at the AFEC, then we look in some sort at the value of the asset. You say saying what now the AFEC has decreased, so which means the value of the asset has decreased. But at the same time, I'm looking at the AFEC as an exchange rate between the dollar and the rand, right? Because when the rand like here went from 8.32 to 8.30. I would say the rand has gained strength because now we will use.
From where?
I current right now at the FEC it was one Australian dollar was equals to 832 rands, right?
Yes, yes.
Then now it reduced to 1 Australian dollar is equals to 830 rands. Then which means in an exchange rate spectrum, we now will require less. Rand has gained strength compared to previously. So now we will purchase, if we are purchasing or recognizing, we will purchase at a lower price than we should have.
Okay, no, that's a good point. But now I want you to understand it this way, all right, in regards to this. So in terms of this, all right, with regards to this. Now, let's start afresh in terms of our FAC. What did we say here? we said, all right, at 8.18, you're going to buy your FAC at 8.18, right? That's what we spoke about, right? We said, no, you're going to buy at 8.18, all right? Which means now, at 8.18, the exchange rate, remember you haven't really bought this thing. You didn't buy, right? You just entered into an agreement with the bank to say you're going to buy at 8.18. Now, the FAC value went up to 8.32, but you made a gain. Why? Because you entered into a deal with the bank earlier. So with the bank, you're going to be paying at 8.18, right? And then in terms of this, the bank is begging you to say, no, the rate is now at 8.32. Now, from here to here, what is happening? It means now you agreed, right, in regards to this. So the value of a FAC, right, in terms of this is at 8.32. So literally, technically, what you agreed with the bank is now 8.32. But now others are buying at 8.30, which means you're on a loss. If you feel confused, there's another alternative way you can master this as well, is to do this. Remember, you have an FAC asset in terms of this. So you said, right, in terms of this, on 1st of September 22, right, the value for FAC was valued how much? So 1st of September 2022, your FAC was valued at 99,000 times. It was valued at times what? Times 8.18. Let's look at it that way. You know, so your FAC is valued at this. All right? This is the value of your FAC that you have. And then on 30 September, all right, in regards to this, your FAC is now valued at how much? So the FAC is now valued at 8.32. All right? This is what the FAC is now valued at. All right? Which means now the value of your FAC has gone up. All right? In terms of this. So FAC has gone up, which means now you have FAC asset. So the value of your FAC has gone up. So in other words, how is it an asset? Because you entered into the deal with the bank to say you're going to be buying it, of course, at 809. But now others are now buying at 8.23860. So what does it mean in terms of this? It means now on 30 September, all right, the value of FAC is 83,823,680. This is the value of your FAC on 30 September. Do you agree with me there?
Yes, I agree with you. And now I understand it. Thank you.
All right, let's move on to 1st of November 2022, in case somebody will be wondering. So on 1st of November 2022, our FAC now is now at 8.13. So we have 99 times 8.13. All right. So what does it mean in regards to this? All right. It means now, look, your FAC is valued at 8.23. Others' FAC is valued at 8.21. Do you see? That's where the loss now comes in, right, in regards to this. So the value of a FAC now has gone down. So that's why we're saying, no, you have a loss in this data. Right. I understand that in most cases, many students make the confusion in the sense that sometimes we want to compare it with the, to say the value for our, what do you call it? You see it when you do the other part for, what is this? The trade receivable, trade payable, and all that, right? But the principle is the opposite. Remember, FAC, you are hedging yourself with the bank, right? But anyway, we'll look into it just now. I'll show you on this journal now, which we're about to look at, so that you see now what's going on in terms of this part. All right, so which means now, right, in terms of this, all right, let's quickly look into it and see now what is going on in terms of this journal. So this journal comes in now that we have now on 1st of November. Now, look, the FAC, we said it's valued at 8.30. But when we entered into the deal, it was at 8.18. So what do we do in regards to this? 8.30 and 8.18. Now, if you're to look at it, right, when we entered into the FAC, remember we said with the bank the deal is 8.18. Now, the actual exchange rate is now sitting at 8.30. Do you see you have made a gain? So it means now the bank is the one now that's going to pay you. They're going to pay you because remember, you're going to need the Australian dollars. All right. So on 1st of September 2022, you are sitting with 99,000 Australian dollars, all right, which were valued at 8.18. Then you told the bank to say, no, this money, you have your rands. These rands should be equivalent to 99,000 Australian dollars on 1st of September 2022. So you have your rands, and then you agreed an exchange rate. In this regard, let's just take 99,000 divided by, let's say 99,000 times 8.18. So you had 809,000 rands, right, in regards to this. So on 1st of September, you had 809,820 rands that you have in hand. And then you told the bank this 809,000 should give me $99,000 on 1st of November. But however, now, because now the exchange rate has shifted, the bank has to top you up the excess. So it means now on 1st of November, the bank is going to pay you money in regards to your FSC. So the bank is coming in and say, you had, in terms of this, 8.18, now the rate is 8.30. So 8.30 minus 8.18. So the bank is going to pay you now the excess amount so that you'll be in position to buy the 99,000 Australian dollars there. So that is how it works in terms of the concept of FEC. So which means now the bank is going to pay you 11,880 so that you're in position to buy these Australian dollars. So you have FAC asset in terms of this SFP. So that is how it works in terms of the FAC. So you agreed if the FAC value had gone down, it means you're the one who was going to pay the bank so that the bank will be in position to transfer your person. But however, because in regards to this, the FAC value has gone up, you're not in position to buy the $99,000 using the money we have. So the bank, because you had a deal, in other words, so literally in terms of this, remember we said you enter into this deal with the bank beforehand. So you said, no, I'm going to pay you, right? In terms of this, Mr. Bank, I want to buy $99,000, right, on 1st of November, but I'm going to give you 809,820. That's what you're going to give the bank. So which means now, since 809,820 is no longer sufficient to buy $99,000, the bank will compensate for the difference. So literally the bank is giving you this money to buy the excess. So that is how it works in terms of the FAC. Please practice some questions there. All right, let's look at journal 4. So the other journal that we can have is with regards to the acquisition of the asset, of course. So in terms of this, they bought the machinery. So if you look at the question, all right, in terms of this now, they are buying the machinery on 1st of November. That's when it was shipped free on board. So you debit the machinery on 1st of November. All right, so you can debit PPE, property, plant and equipment, or machinery, still fine. Property, plant and equipment, SFP. With how much? 99,000 times. So here now, the machinery, we use the spot rate on the date of shipment, which means we use 8.13. So multiply by 8.13. All right, so that is how we go about it. We have 8.13 times 99,000. So to give us that. Then we credit, in terms of this, we credit, is it a cash or a credit sale? So let's look at it. So the machinery was shipped, right? When did they pay them? Let's just quickly see, when are they paying? They paid on 1st of December 22. So that means we have trade payable in this regard. So they have their payable sitting like this, all right? And then let's go to December now when we're doing the actual payment, which is 1st of December 2022. They're doing the actual payment. So before they do the payment, we need to assess the payable, all right, in regards to this. So this is journal 5. What's going on in terms of our payable? So the value that we are owing the Australian company, of course, on 1st of November, we're owing them at 8.30. Now the rate went up. We're now owing them at 8.35. It means now we're owing them more money. So that means the value of the payable goes up. So we have fair value loss. We have another loss, P&L. And then we have trade payable. Please understand this principle on FSC and even these payables. We're going to look at that also in tax when you do test 2. So please master these principles because this is not the end. It's still coming back again on tax. Right? So you need to know what's going on. So the 8.35 minus 8.13 times 99,000. So that's the payable. The value of our payable is going up. Right, so our payable, the value went up. So which means now in regards to this, that's what we have. Then of course we do a journal for the payment. So we have trade payable. And then we credit bank, it's money leaving our business. So in terms of that, we have 8.35 times 99,000. So that's what it gives us the value there. Right, then take us to this amount. So that is how we go about it in terms of our calculation for the journal entries. Any questions, guys? Any questions, guys? No questions. All right, let's proceed now to see what's going on now in regards to this part. All right, so the next part now, right, we want to look at, of course, the other part, which is about the statement of change in equity. Let's quickly look into it. Let's see what's going on. So, B says prepare the statement of change in equity of Ultra Motors for the year ended 30 September 2022. Right? So B, statement of change in equity. Right, let's quickly see what's going on there. All right. So I know most of you struggle with this part, but of course there's new IFRS standards. All right, I'm still using the old ones. But let's just go to the part that is examples, right, of all IFRS standard to see now how the layout of state change equity looks like. Right, let's go to part B of our IFRS. Right, please go there. I don't have the 2026 standards. My standards are a bit old. So I'm using IS1, all right? But of course, the guys with the latest standard, just I want you to check for me. If you go to, I believe, IFRS 18, right, since it's the replacement of IS1. So if you go to IFRS 18, you should have an example that is statement of changes in equity for the year. Right? It starts with share capital, retained earnings, translation of foreign operations, investment in equity, cash flow hedges, revaluation surplus, non-controlling interest, then total equity. I don't know if you can see that example there. Anyone using the 2025 IFRS books?
I'm using it.
You're using. Did you find the example we are referring to here?
Can you please repeat which one it is?
So we're looking for statement of changes in equity under, if you open IFRS 18 example, so at the top you should write IG somewhere around that. Is it
Yeah, I
IG?
think I found, yeah,
No, it's written. Come
B580.
again. Come again.
B580.
B580. All right. Anyone using the latest book
Something
to see
about it.
what's happening? Thanks. You are the best. All right. Right. If you guys are with me, let's now look at, in terms of this, let's now see what's happening. So do you see the layout of the statement of change in equity? You can see you have your own share capital, retained earnings and all that, but we can't start presenting the layout. For now, let's just read through what's going on there on our question. Right. So being told now, based on the presented information, look, except for transaction 1, which was correctly accounted for. So transaction 2 to 4 must still be accounted for in the financial statement. So it means transaction 1 was recorded in the calculation of the profit. Right. So loan incurred. Ultra Motors borrowed 1 million from Altex on 1st of September 27. Interest amounting to 100,000 is payable annually. So there's interest of 100,000 payable annually on 30 September in respect of the loan. The repayment term states that the loan capital must be repaid at a premium of 200,000 on 30 September 22 to compensate for the low nominal interest rate compared to a market rate interest rate on a similar loan. You may assume that the loan and the related interest were treated correctly in the accounting records of Ultra Motors up to and including 30 September 22. The loan amounted to 1,200,000 in Ultra Motors books on 30 September 22. During September 22, Ultra Motors was in the process of expanding its business operations. To reserve funds for the expansion, Ultra Motors renegotiated the terms of the repayment of the loan with Altex. Ultra Motors proposed the following terms of redemption of the loan. To redeem the loan, right, by issuing 120,000 preference shares of Ultra Motors to Altex on 30 September 22. Preference dividend payment are made within the discretion of Ultra Motors. So that means it's now equity, right? The preference shares will be converted on 30 September 24 into the ratio of 2 ordinary shares for every 1 preference share. I'm sure you can see that the preference shares are redeemable or are converted into a fixed number of ordinary shares. That makes them equity. All right. Altex accepted the proposal on the basis of growing the investment portfolio. The loan was redeemed on 30 September 22 by an Ultra Motors issuing 120,000 preference shares of Altex. The redemption loan has not been accounted for by Ultra Motors. You may assume that the preference shares are correctly classified as equity instrument in terms of IAS 32 financial instruments. Presentation and other total fair value thereto amounted to 1,400,000 on 30 September 24. So as regards the redemption on the loan by the issue of preference shares as capital in nature and therefore allows no tax deduction in respect of the redemption on the loan. So basically this is what we have in terms of our loan there. All right. So how do you deal with this? Let's proceed. Issue of convertible debentures to generate additional cash. Ultra Motors issued a total of 100,000 10 rand debentures at a discount of 20% on 1st of September 22. The debentures carry a coupon interest rate of 12% per annum, which is payable annually on 31 December. The compulsory convertible debentures will be converted into Ultra Motors ordinary shares in the ratio of 1 debenture for 2 ordinary shares on 31 December 28. There is no option for cash settlement. A market-related interest rate on similar debentures without conversion rights amounted to 9% per annum on 1st of January 2022. No entries have been made in respect of this transaction. Assume that SARS accept the amortized cost of the debenture as the best cost of the debentures. Ultra Motors received a tax directive from SARS indicating that future taxable profit on the debenture will be taxed at 27%. Transaction for investment in shares. Ultra Motors invested 200,000 ordinary shares of Speedfast on 1st of October 2021, which represent 10% of the issued shares of Speedfast. Ultra Motors is dependent on Speedfast for the supply of its products and therefore regards this investment as a long-term strategic investment. On initial recognition of the investment in Speedfast, the management of Ultra Motors elected to recognize changes in the fair value of the equity instrument in other comprehensive income using the mark-to-market reserve. The investment was acquired at fair value when the share price of Speedfast ordinary shares was 6.20 per share. Transaction costs directly attributable to the acquisition of the investment amounted to 23,000. The fair value of Speedfast ordinary shares on 30 September 2022 amounted to 8.45 per share. For tax purposes, the transaction costs are included in the tax base of the investment. Additional information. The issued share capital and retained earnings balance of Ultra Motors on 1st of September 2021 amounted to 3 million and 2,340,000 respectively. Ultra Motors profits after tax amounted to 3,765,000 for the year ending 30 September 2022 before considering the redemption of the loan, transaction 2, transaction 3 and 4. The nominal income tax rate is 27% and capital gains inclusion rate 80%. So basically that's what I have, right, in terms of this part. So now let's use our example with regards to this part to see now the layout of our investments there. All right, so in terms of this, we're looking at symbol of change in equity. So we have column, can see there there's share capital. Right, there's a column for share capital. Right, then we can have a column for other equity components. We can have retained earnings. All right, we can have the preference shares. All right, what else do we have? Translation of foreign operation, we don't have. Investment in equity instruments, of course, that's preference shares. Revaluation, we don't have anything like that, right? So basically that's what we have, and then maybe let's see if there's other components, we'll fill it in, right? And then, so to start off with this, there was no, of course, we have balance at the beginning of the period. So balance at 1st of October 2021, of course, all right? And then just keep, then you have your closing balance. So balance at 30 September 2022. So let's start with share capital. There were no share capital issued, no new issued share capital. So share capital, the balance, look, 1st of October 2021 was 3 million. So you're just going to start with 3 million there. Right? They did not issue any new shares there. So which means in terms of share capital, we remain with that. So that's basically what we have in regards to this. So the main issue now is with regards to retained earnings. Let's see what's going on in terms of retained earnings. So we're given the balance of retained earnings at the beginning of the year, which is 2314. So that's our balance. There were no errors or anything, right? Or prior period adjustment. So the balance of retained earnings still remains that, right? And then what do we need to adjust for? So if you note on our note there's dividend. They didn't pay any dividends, did they? No dividend was paid. So we're just going to have total comprehensive income. Total comprehensive income. So when you talk about total comprehensive income, literally we are referring to profit for the year. All right, that's what makes up total comprehensive income. So let's do workings now. All right, so we're given the profit for the year. So profit after tax amounted to 3,765,000 for the year ended 30 September 22, before considering redemption of loan transaction 2 and transaction 3 and 4. So we have, of course, we have Let's just call it working on. So we have profit after tax, right? So in regards to this, the profit after tax that we're starting off with is the one that they gave us in the scenario. So the profit given is going to sit at 37.65. Right, so the profit is given. Then they said, no, they never considered transaction, the issue of the loan under transaction 2, 3, and 4. So 2, the issue of the loan, so they never considered the issue of the loan. So what is happening in terms of this transaction? So there's a loan which is now being exchanged. So a loan is being exchanged for what? For preference, for what do you call it? A loan is being exchanged for preference shares. That's what's transpiring, right? Let's quickly see. Oh, I left the other book. That's it. See. That's one of those small standards, all right? Right. I want us to look at right, let's just quickly go. That's what is happening. So Ultra borrowed 1 million from this, all right? And then they decided on this debt. Alex accepted the proposal. Let's see what is the proposal. During September, Ultra Motors was in the process of expanding its business operation, all right, to reserve funds for the expansion. Ultra Motors renegotiated the terms of the repayment of the loan with Alex. Ultra Motors proposed the following terms of redemption of the loan. To redeem the loan by issuing 120 preference shares of Ultra Motors to Altex. Preference dividends are paid within the discretion of Ultra Motors. Preference shares will be converted on 30 September 24 into ordinary shares. Altex accepted the proposal on the basis of growing the investment portfolio. The loan was redeemed on 30 September 2022. Right. So in terms of this, as you guys can see, the preference shares are equity, right? In terms of this, right? The preference shares are coming in as equity. I'm sure you guys can see in terms of this, right? And then now the loan is a liability. I'm sure you guys can see in regards to this, right? So that means now we have equity and a liability. They are being exchanged. Can we go to IFRIC 19 on our book? IFRIC 19. So it's part A2. I don't know if you guys can go there. So it's IFRIC 19. Just write that. So it's IFRIC 19. I want us to go to paragraph maybe 8 to 10. 8 to 9, I mean. Let me know if you're there. It's towards the end of your book. The IFRIC, you'll find it at the end of your book. Are we there, guys? Not yet.
We are there.
You're there. Anyone struggling? Right, good. So if you're there, right, let's read and see what's happening. So the first thing, IFRIC 19, is about extinguishing financial liability with equity instrument. So in terms of this, what you have to pay attention is this standard. It applies when you are exchanging financial liabilities with equity. So what is happening? The loan is a financial liability, as you guys saw, right? The loan was a liability in the books of Ultra, in the books of Ultra Motors, right? Remember they borrowed a loan of 1 million. And then now the preference shares, as you can see in regards to this, the preference shares, the dividend on the preference shares in terms of IAS 32, the dividends are paid at discretion of Ultra Motors. That makes it, it's not mandatorily payable. That makes it equity. Also on maturity debt, look, the dividend are converted into 2 ordinary shares for every 1 preference shares. So the preference shares, are converted into ordinary shares, 2 ordinary shares for 1 preference share, making it, the instrument is converted into a fixed number of shares. That makes it equity as well. So that means the preference share is equity in terms of IAS 32. So they're exchanging liability for equity. Now, what does the IFRIC 19 say in that regard? So it comes in now and says, paragraph 8, it says, if only part of the financial liability is extinguished, the entity shall assess whether some of the considered paid led to a modification of the terms of the liability that remained outstanding. If part of the consideration paid does not lead to modification of the terms of the remaining part of liability, the extinguished and the part of the liability that remains outstanding, the entity shall consider all relevant facts and circumstances relating to the transaction in making this allocation. But now that's not what we have. There's no part, everything is extinguished. Now, paragraph 9, it says the difference between the carrying amount of the financial liability extinguished. So here the carrying amount of the financial liability extinguished. So financial liability extinguished. All right. So it's carrying amount, the carrying amount of that liability that's been extinguished is sitting at how much? They gave us in the scenario now that the carrying amount of the liability is sitting at 1 point, carrying amount of the liability is 1.2. All right, so carrying amount of liability is 1.2. All right, and then the consideration paid. So the consideration paid, how much are they paying? Preference shares, that's what they're paying as consideration. All right, so in terms of this, the consideration paid, all right, is sitting at, we saw that the value of the preference shares is sitting at 1.4. They told us there. So which means now 1.4. Now the difference, right, in regards to this shall be recognized initially and measure the debt of liability. Right, in terms of this, shall be recognized in profit or loss in terms of paragraph 3.33 of IFRS 9. You can go to IFRS 9 as well, paragraph 3.33. So you go there, see what's going on. So accounting is about linking those paragraphs. So let's just go to IFRS 9, paragraph 3.33. All right, so paragraph 3.3 talks about derecognition of financial liability. Guys with me, please go there. I'm looking at part 1. So IFRS 9, paragraph 3.33. I don't know if you guys can read that. So 3.31 talks about derecognition of financial liability. So 3.3 says the difference between carrying amount of financial liability extinguished or transferred to another party and the consideration part, including any non-cash asset transferred or liability, shall be recognized in profit and loss. So which means now the difference between these two is what you're recognizing in profit and loss. So yeah, they paid 1.4 for a loan that's worth 1.2. Do you see there's a loss? They made a loss of 200,000 in regards to this. So that's the part that's extinguished. Is it clean, guys, or you are lost? Anyone, guys? Should we proceed? Oops. Today you're silent. All right. Should we proceed, guys? Okay, cool. Right, so transaction 3, issue of convertible debentures. So to generate additional cash, Ultra Motors issued a total of 100,000 10 Rand debenture at a discount rate of 20% on 1st of January 22. The debenture carry coupon interest at a rate of 12% per annum, which is payable annually on 31 December. The compulsory convertible debenture will be converted into Ultra Motors ordinary shares in the ratio of one ordinary debenture for 2 ordinary shares on 31 December 2022. There is no option for cash settlement. Now, let's first assess in regards to this, is the convertible debentures a compound financial instrument? Is it a liability or what's going on? Now, let's start off with the coupon. Look, the debenture carry a coupon of interest rate of 12%, which is payable annually. So that means the coupon is a liability, right? And then after that, what else do we have? We can see in terms of this, at maturity, the debentures are converted one debenture for every 2 ordinary shares. So they are converted into a fixed number of ordinary shares. That makes it equity. So the debenture now is a compound financial instrument. All right, so it's a compound. Remember, we spoke about this. All right, we said we assess the terms of our instrument, the loan, the maturity debt, as well as the installment. So we saw the installment is compulsorily payable. So that makes it, in regards to this, it makes it a liability. So in terms of this, which means now the PMT, in terms of our debentures, we have what the coupon rate is given there, 12%. Right? So with 12% times, multiply the coupon by what? By par value. So what is the par value or face value of our instrument in regards to this? Right? So which means now, in terms of this, let's quickly look into it to see the par value. So total, they issued a total of 100,000 10 Rand debenture at a discount of 20%. Right? So literally, that is what we have. So we have issued 100,000 10 Rand debentures. So it means now the first value of par value is 10 Rand. So 10 times 100,000. So this is what will give us the value for our debenture. So 12% times 10 times 100,000. So that's what we have in terms of our debentures. So the debentures are sitting there. Right? Then we proceed after that. And then when do they mature? Possibly our end. So they issued them on 1st of January 2022. They mature on 31 December 20. So 22, 23, 24, 25, 26, 27, 28. So N is 7. So N is equal to 1st of Jan 2021. Also 2022 until 31 December 2028. So since they're making one payment per year, means 7 times 1. Then maybe future value. What is our future value? In redemption, so we saw there they are redeeming them they're converting them into shares. So it means future value will be 0. And then I, let's see, are we given the market interest rate of the debentures? Right. So in terms of this market interest rate on similar debentures without conversion rights, remember I said we use interest rate without conversion rights. So in terms of this, the interest rate without conversion right is sitting at 9%. So it's 9%. Right, can you guys quickly work out present value, the value of the liability? Quickly, guys, let's work out PV, because we're going to need it to calculate, of course, the other component there. So it's going to sit at this. So that's the amount that we have as our So PV. So this is the liability part, right? And then which means the equity part in terms of our debenture is going to be, so in regards to the equity component now, so we have 10,000 to 100,000, I mean, times 10. But now remember that we are told now that they were issued a 20% discount, so which means times probably 80%. So times 80%, then minus 603,954. So this will give us the value now for the liability. Sorry for the equity, I mean. Do you guys follow what's going on there?
The discount part, why are we only discounting on the equity?
On the what? No.
The equity amount.
Remember, we've been told that the debentures were issued at a discount of 20%. So in other words, the amount we paid to buy this debenture was 100,000 times 10 times 80%. That's what they paid, right? Actually, this is what that's what they paid, right, in regards to this part of the debentures. So they received, I mean, not paid. This is what they received. So they received 100,000 times 10 times 80%. That's what they receive in total. But this amount is made up of what? It's made up of the liability, which is the installment they have to pay, and the equity part. So now I get your point. So your question is to say, why are we only multiplying with 80% now? Are you saying we should have multiplied with 80% maybe on the PMT as well?
Yes.
Now, PMT is calculated on face value. So PMT is calculated on face value or par value, right? It's not calculated on discounted amount. So that is how it works in regards to debentures. We do not calculate the installment on discounted or the amount of the premium. It's always calculated on the par value or face value. Are you with me there? So we always use that, all right? We don't consider the discount. The only discount time we consider the discount or the cash price is when we're calculating the difference between the equity component and the liability component. All right. So which means now the equity component is there. So that means now, right, on our statement there, we might need to, of course, consider maybe including, right, regards to this. We might consider including that calculation now on our part there. Right? We need to consider it in the statement of changes in equity, right, regards to this part. Right, but before I do anything, are we on the same page so far? Okay, your silence is scary. I'm not sure if you guys are following, but I'll just assume that you guys are following. All right, yes, sir.
Just to be sure. So if we were not gonna exchange this for ordinary shares, right, on the future value, if we're going to use we're going to pay back on maturity date, the future value will be discounted of that 20%, right?
No, the future value is the future value was going to be the par value, unless if they said it's going to be at a discount. But if they said it's going to be redeemed, right? If they said the debentures are going to be there's a cash settlement at maturity, we're not going to use 80%, but we're going to use the par value.
Okay, thank you.
Unless if they tell you that it's going to be redeemed at a discount or at a premium. Right? But if you don't,
they have to specify or it's going to be redeemed at that.
Yeah, but if they are silent, always redeem at par value.
Okay, thank you.
All right, good. So basically that is how it works. So which means now the information we've calculated, what does it affect, right, in regards to the information? So it's going to affect, of course, the statement of profit and loss. Remember, interest from the debentures, I'm sure you guys know, the interest from the debentures we record it as forming part of our what do you call it? It forms part of the profit and loss. So we need to calculate interest on the debentures, So interest expense. All right, so in terms of this, since we issued the debenture 1st of January 2022, so we're ready for January 2022, our year end is 30 September. So which means now the interest we can just take in regards to this, the present value for our debenture 603,954 times the interest rate we said is 9% times January, February, March, April, May, June, July, August, September. It gives us 9 months, 9 out of 12. Or alternatively, you could have gone to amort on your financial calculator. You compute the interest for the first period. But now the calculator is going to give you the interest for the whole year. So which means that the interest you get, you multiply with 9 out of 12. All right, so basically that is how we go about it in terms of this part. Any questions, guys? So the interest that we have in the statement of profit and loss will be this amount. So interest on debentures. All right, so it's calculation 2. So we say the interest on the debenture is sitting at this amount. All right, so in terms of this,
Yes, Captain Can.
so this is the amount that we have as the interest on the debentures. All right. Any questions, guys? Right, so that's what I have is the interest on the debenture. All right, then we proceed, all right, in terms of this. So it's told now that the debentures are convertible into equity. So we said the debenture is an equity part. So we need to record now the equity part on the debenture. So equity on debentures, all right? So equity component. Debentures. Right, so in regards to this, we can include the equity component of the debentures. So you might want to go to IS1, right, in regards to this to see what is happening there. Right, so here we just have, of course, and we can add another one line, issue of debentures. They were issued in the current year, issue of debentures. Right, so we calculated it under 2. So let's see in terms of the issue on debentures, what is going on in regards to that part. Right, so we are dealing with transaction 3, right, and then we're being told now, right, Ultra Motors received a text directive from SARS indicating that the future taxable profit of the debentures will be taxed at 27%. So literally in regards to this, we're just being told now that the part of the debenture is going to be taxed at 27%. So which means the remaining part on the debenture that we record there is going to be after tax, right? It's because of that statement. So after tax, equity component, so it's going to be 196,046 times 73%. 73 came from 27 minus 100%. So 196,046 times 73%. So take us to this amount. Right, so 143, that's what we record as the issue of the debentures. Issue of the equity component of debentures. So record it there, then of course we record it in the total column there also. Right. So the debentures is done. We'll move on to the next leg. We have investment in shares. So Ultra Motors invested 200,000 ordinary shares of Speedfast, all right, on 1st of October 2021, which represent 10% of the issued shares of Speedfast. Ultra Motors is dependent on Speedfast for the supply of its product and therefore regards its investment as a long-term strategic investment. On initial recognition of the investment, Speedfast, the management of Ultra Motors elected to recognize changes in fair value. Changes in the fair value of the equity instrument and other comprehensive income using the mark-to-market reserve. So in other words, this investment now is measured through mark-to-market reserve, OCI, fair value through other comprehensive income. The investment was acquired at fair value when the share price of Speedfast ordinary share was 6.20. Transaction costs directly attributable to the acquisition of the investment amounted to 23,000. The fair value of Speedfast ordinary shares on 30 September 22 amounted to 8.45. For tax purposes, the transaction costs are included in the base cost of the investment. So literally, that's what we have. So which means we have mark-to-market reserve transaction in regards to this. So we're gonna add one line item also on the statement of changes in equity, which is mark-to-market reserve. Right, remember we spoke about this. So we have mark-to-market reserve. Let's quickly see how are we going to account for the mark-to-market reserve. So it looks like there is nothing else that affects the statement of profit and loss, all right, in regards to this, which means now we might now consider accounting for our items making the statement of profit and loss. Right, so our statement of profit and loss, we have this, all right, 37, and then we have that 200, and then we have this amount. You know, so that's basically what we have as forming part of this. Right, we did include the interest on the debentures. All right, I think that's all right. All right. So you have our profit, right, for the year. It's going to come into this amount. So profit after tax. So we have it there, then we just record the profit after tax under other comprehensive income. Show that you calculated it under 1. All right, so your profit is sitting there, and then you do your totals there. Right, so that's what you have in your profit column. Then you move on. The preference shares, we didn't record anything. Okay, we'll come back. Let's deal with the mark-to-market reserve and see what is going on. Right, so in the mark-to-market reserve, when did they issue the shares? So with the 1st of October 2021, that's when they issued the shares. So which means now in regards to this, the shares, of course, they were issued in the current year. Remember, our year is coming from 1 October 2021. So we didn't have a balance for 2020. So we don't have the opening balance on 30 September 2021. So that means we are good in regards to this. Right, so that means we don't have any opening balance for mark-to-market reserve. Right. So let's quickly account for the mark-to-market reserve to see now what is going on in terms of this part. Right, so they issued them, in regards to this, at 6.20. So 6.20 times the number of shares, right? So in terms of this, that's what we have. So mark-to-market. So we're looking at the fair value gains that we record in the OCI. I'm sure you guys still remember from the journal. So issue value. So they issued it how much? So told now they were issued at 200,000 times 6.20. Right, so then give us our value there, 6.20 times 200,000. Right, give us that. Then we add transaction costs, right? I'm sure you guys still remember because they are measured at fair value through OCI. So transaction costs are added there. So it means now our value plus the transaction cost, 23,000. We want to calculate the fair value gain or loss. So which means now the value of our instrument on the issue date, you know, value of the shares, right, on 1 October 2021, sitting at that. Now, what is the value of the shares at year end? All right, so in terms of this, we've been told on 30 September, 30 September, the shares are now trading at 8.45. So which means now the value of the shares is at 8.45. Value of shares. Right, so 8.45 times 200,000. Right, so we have 8.45 times 200,000. And take us there, which means now in this regard, you see the value of our shares, it went up. Right? So we have a mark-to-market gain in this regard. So which means now this minus this, right? It gives us 427,000. So 427, of course, is the amount that we have to record in the mark-to-market reserve. But now, tax on the valuation. Right, so the taxation on the valuation will be 427. Now, shares, we use 80%. They will multiply with 27%. That is how it works. So it means now we have 427 times 80% times 27%. It takes us there. Then we net off these amounts. Right, so that means now, after tax, the value after tax mark-to-market. Right, I hope you guys too remember we did this in journal entries. I'm sure you guys now will know what's going on there. Right, so that's the amount that we record in the mark-to-market reserve. Right, issue of shares. Right, so the shares measured through OCI. It wasn't bad, right? The exam. Of course, it required a bit of practice, but I think it's a good practice question. Right. So that's what we have in our mark-to-market reserve. Then we record, of course, the closing balance of our mark-to-market. Right. And then we looked at the preference shares. Let's quickly see what happened on the preference shares in this regard. Remember, there's issue of preference shares. So issue of preference shares. Now, the preference shares were told their value. In terms of this, the preference shares were valued at, the fair value was 1.4. So the preference shares are valued at 1.4. So just record 1.4 there. And then we have 1.4. Right, then that's basically more or less like what was expected of us there. Any questions for me, guys? Do you agree with me? If you practice questions, it's doable. But if you don't practice questions, that's where problem can start. But if you practice questions, it is actually doable. Right. All right, I can say practice as many questions, guys. All right, we can do it, guys. All right, trust me, we can do it. Bye, guys.
Bye.
Bye.